Let's connect with Devang Mehta as well, who joins in on the show. Good morning, Devang. Why don't we start off with those blockbuster IT numbers? Infosys in particular, would you say that the biggest takeaway was that highest ever large deal TCV number at $7.1 billion? And, do you believe that this outperformance of Infosys versus the IT index consistently over the last 6 months, 1 year, 1 month even, is likely to continue?
Good morning, Aman. Thanks for having me on the show. I think, yes, clearly what we have seen across the IT pack, not only Infosys, but even TCS, for that matter, even Wipro, the numbers actually have been sort of blockbuster. And I think last 5 years, we have seen probably the seats change as a blue-eyed boy for Infosys and TCS. There's always been a tug of war as such, that who claims that first place in terms of consistent delivery of numbers on the margin front, on the constant currency growth. I think what we have seen across in this quarter and the last couple of quarters as well, that IT has just come back to the fore, and we know that how the world is shifting towards information technology and digital revolution. And Infosys also sort of deriving almost 40 to 50% now out of its digital business. It augurs extremely well. Plus margins of these companies have been expanding, and the deal pipelines and the management commentary, if you listen to their commentary as well as their body language, has been extremely confident. So I think we are, though the stock prices have run up a little bit ahead of expectations, but give and take 5 to 10% here or there, I think this all companies will remain buy on dips for the next 2-3 years.
All right. Well, it'll continue to be all about IT, of course, today. We'll watch out for that. Devang, some eyes also on the commodities and really which direction you think they'll take going away from here. We're watching, of course, SAIL for other reasons. So SAIL Authority will continue to be in focus on the back of that OFS, but we've also got some of the other steel majors in particular that have been seeing strength. Do you feel that there's still, a meat left in this rally?
I think, Abha, yes, there is some meat left in the rally, but the only problem with cyclicals and as such metals as a sector, be it aluminium, steel, or even copper, I think it's extremely difficult to gauge the trend of this type of commodities. What we have seen is, yes, a lot of pent-up demand across the world, and even some structural demand in India has come back. Also important to say that metal prices have just shot out of the roof. And if you talk to vendors and companies over here, a lot of companies say they don't have stock of supply for supply. So there's some bit of shortage which is there in the commodity cycle, and that is, I think, still out to be explored. So yes, there can be some upside here, but we would be ready to sacrifice that type of an upside for just reasons which are out of fundamental control. I think, yes, there are a lot other sectors which are proxy plays to this type of metals or cyclicals, so we would focus over there. But yes, people who would have bought Tata Steel and stocks like that, it's a good time probably to hold, if not buy.
Okay, so that's on some of the steel majors as well. Devang, we were talking about M&M earlier today, and the kind of factors that are possibly playing into the strength that we're seeing on Mahindra & Mahindra. I mean, outside of that, even across some of the other auto names, we have seen some pretty strong action building up this week. Within the pack, then, what have you got your eyes on?
I think this has been a real blockbuster type of a rally for all the auto stocks almost. And I was listening to the conversation that you and Nikunj were having. So yes, a lot of productivity improvement has happened across the corporates in India, across listed corporates. And what we saw for particularly companies like M&M, how efficiency proved very, very important for these companies, and how management just rose to the occasion and changed a lot of dynamics of the business, and productive businesses were given more leeway and more sort of an operating impetus to operate. So such measures taken by a lot of these companies helped them to come out of the bad cycle, plus pent-up demand, which was there for the last 2 years. I think the auto stocks went through the worst phase in the last 1.5 to 2 years, and I think they were just written off for reasons unknown, from BS4 to BS6, migration earlier, the insurance issue, and a lot of such issues were there. I think this demand right now, which was a debate that whether it is pent-up or structural, seems a little more structural looking at the December sales number. Probably January, February, March would give us more idea. But yes, companies like Eicher Motors, Maruti, we had in our portfolios, and that underperformed for a long while. I think this all have come out and started to do very well. So yes, this as a theme again would sort of remain as buy on dips, but you need to be very, very selective over here because the stocks have run up too far ahead of expectations.
Suresh, is Mahindra & Mahindra headed towards 1,000 or that will be a stretch?
The way the chart is shaping up, eventually we would be headed towards that. So the big change in terms of momentum for the stock was that if you look at the price action for the last 6 years, so we had a dash towards 700 back, 700, 750 between 2014 to 18, and we just could not sustain above that. And finally, we did take up to 1,000 rupees back in 2018 mid. And since then, it went all the way to almost 300, sub 300 levels. So finally, even on the longer term basis, we've crossed above that 750 mark. Also, the last 2-year highs are about 650. And also, this was a rank underperformer even going into COVID. So what we are seeing is this is a longer term trend change which has been done. We made a recent breakout, did a retest, and we've started a new leg about 750. So any dips back to 750 is a good entry point, 750, 770 for a longer term play. And looks set for 1,000, but it could not be happening in, say, extreme hurry. But overall, the trend looks set for 1,000 or maybe even higher in the long term.
On the charts, Kunal, which is the strongest large cap IT stock? TCS, Infosys, or Wipro?
Well, in the last few months, I think Wipro and Infosys have gained more traction. I was looking at the comparative, price recovery for the many of these IT names. Of course, the mid-cap IT stocks they've done exceptionally well. Many of these stocks have gone 4x, 5x. The likes of Tata Elxsi, etc. But from the large-cap IT space, Infosys and there's a bit of a juggle between Infosys and Wipro. In fact, what is very interesting is, Nikunj, I was looking at the charts for Wipro in last 3 days when TCS delivered its results. Wipro was at 420, 425. Post result, Wipro has gained more than 10-12% higher from those levels. Infosys has recovered more than 6-7%, and TCS rallied by I think 5 or 6% odd on the result itself. So there has been more steady outperformance coming in Wipro as compared to many of these other large cap IT names. But I've seen historically that at least historically the last so many years that there has been a juggle between these kind of outperformances. So there is a phase where Infosys tends to outperform the large cap IT space, and then TCS and the other stocks they manage to play a catch up. So I believe this is the kind of rotation which could probably play on. Yes, currently Wipro and Infosys they look more of stronger stock in terms of outperformance. But then if this internal stock rotation plays out in terms of sector, then I believe even TCS would probably try and play a catch up pretty soon.
Devang, would you lean towards mid-cap IT because if large-cap IT is growing exponentially, mid-cap IT will also grow. The base effect is also favorable. Now, mid-cap IT stocks are not that expensive. What are your top 2 ideas from the mid-cap IT space?
Yes, Nikunj, probably IT as a space overall looks good, and as you rightly said, the large cap IT has already delivered, and some of the mid cap IT ideas which operate not only out of India or abroad or in the offshore market. A lot of companies operate very well in Indian market as well. Companies involved in artificial intelligence to a lot of such automation ideas or automation procedures can probably do well. So of course, we had companies like L&T Technology, which we had been bullish since quite a long time. The company again underperformed for some time, but it's again come back and performed extremely well, and the numbers will show in the next 2 to 3 quarters. So a company like L&T Technology, of course, Honeywell Automation we have been liking since a long time. It's not nowhere in the IT space, but as an infra substitute or in the automation space, such type of alpha themes would probably do very well in the market where there is right now a demand for great companies, good companies with high ROE, high ROC, sort of low debt. So I think these themes will probably prevail for a longer time.
All right. SPI, Devang, let's get your take on that. In terms of, as Nikunj called it, receiving sort of stepmotherly treatment from the markets. Do you feel perhaps now poised for a new round of momentum?
I think, yes, clearly what we are seeing across in the banking sector is there's been a laggard rally, which probably is also prevailing as a theme in the market. And how the private banks ran initially, the companies like HDFC Bank, Kotak Bank, and then Axis and ICICI. I think clearly there is the under ownership in PSU banks, as I think rightly known by the market participants. SBI probably as a play for capex or a play for maybe a corporate as well as a retail bank, and as a substitute for the GDP growth. I think it's clearly one of that candidates. But as I said, if you want to be with the companies which probably give you 5-year, 10-year CAGR returns and don't want to miss out on a bad cycle, good returns in a bad cycle. I mean, I think then there are private banks which still has a case of 18 to 20% CAGR for the top banks. Yes, SBI would come up with its set of risks, and whenever there would be farm loan waivers and stuff like that, or according to the government's sort of behavior, I think that will be more of SBI. SBI will be dependent on that. So rather than getting into PSU banks, the advice would be to get into high quality financials like top private banks, even insurance companies which have just started to come back to the fore. I think these companies on the back of lower penetration and density will keep on continuing what private sector banks did for the last 10 years. I think insurance as a sector can do for the next 10 years.
Perhaps we'll be watching out for today. Steel Authority continuing to see, of course, action on real estate. We've got DLF Hines JV to invest about 1,300 crores on construction of a new commercial project that's coming up in Gurugram as well. Let's also take a check on DLF, Devang, because again, this has been a stock that's been standing out, and of course, with any news, is bound to see further interest.
I think building material as a proxy play, and I know I always talk about this theme that it's been a extremely a rock star type of a sector, be it adhesives, be it paints, be it even ceramics, or even now lately even cement. So I think real estate as a space, yes, has surely emerged, but if you don't have the wherewithal to get into the space which is real estate because of reasons known, like probably high debt or extremely cyclical in terms of business, though the time has come in the next couple of years, on the back of at least Maharashtra doing its stamp duty cut and some of the states are also thinking about it, the time would be good for real estate. But what we need to look at as a proxy place building materials, because it will be beneficiary of both. The new demand which will come back as a matter of fact when prices come down, or at least a new demand which was pent up demand during the lockdown times. And third is the replacement demand, which is still going to prevail, I think, eternally in India. So the home painting cycles and all have come down drastically. The furniture making cycle has also come down. So I think these themes would probably be a lot better than playing directly real estate, though it can give a good rally. But your peace of mind and stress adjusted returns will come from building materials as such, paints and adhesive sector.
All right, let's connect with our chartists now to find out a little bit more about their mid-cap strategies. It's flat for the pre-open rates this morning. And Naresh, what's on your radar?
So buy on Bata with a stop loss at 1575 and a target at 1800. The stock gave a breakout above 1575 and has been making a range bound move between 1600 1670 for the last few days, setting up for the next leg of the move, preempting the breakout at current levels with a stop loss at 1575. And the trend seems positive for the stock from here.
Bata India it is. And Kunal, your top mid-cap call of the day.
It's a ban. KPR Mills, the stock has had almost 6 straight months of strong price uptrend. But, every time the stock manages to come back, retrace its 50-day moving average, there is a significant bounce which happens into the stock price, almost a 15 to 20% bounce, which shapes up into the stock price. On the short-term charts, it's forming a bullish flag pattern yet again. So would be bullish on KPR Mills at current levels of 968, approximately targets of 1010, and stoppers should be kept at 950.
All right, let's break it down then and tell you about the top 5 stocks to watch out for in trade. Without a doubt, it's those IT majors. Wipro, it's been a strong beat across the board, the strong revenue guidance as well. Margins expanded to the highest in 22 quarters. The order book was a good mix of large and small deals, and several operating metrics were at an all-time high, with revenues up 3.7% sequentially, and the guidance for the IT revenues at 1.5 to 3.5% sequentially. Infosys as well delivered its report card, and it was a very strong quarter across the board that the company delivered. In fact, you had a strong set of numbers coming in terms of their overall revenues, which were a beat at $3,516 million. The net profits as well grew to $5,215 million and crores, and you also had the overall guidance that was on the upside. Meantime, SAIL is in focus in trade today on the back of the OFS that's been launched by the government for 20.6 crore shares at a price point of 64 rupees. The government will be selling up to 10% stake, and this opens today. Defense stocks like HAL, Bharat Dynamics, BEML, BEL will be in focus as the Cabinet Committee on Security cleared 47,000 crore worth of deals for 83 indigenous Tejas fighters. And JK Tyres, a subsidiary which is Cavendish Industries, has recorded nearly 30% growth in sales. The EBITDA at about 157 crores has jumped nearly 1.2 times. So there you have it, all of those top 5 stocks to watch out for. But it would be interesting to do a deep dive into IT as well. It's certainly been a hat trick of sorts. The likes of TCS, Infosys as well as Wipro have delivered stellar set of numbers in Q3, and it's been a beat on all fronts for all of them. While the company Wipro and Infosys, yes, have revised their guidance upwards, let's do a comparison, a drawdown comparison between the 3 IT majors on parameters like their PE, their deal wins, their revenue metrics, and find out what the pecking order is. My colleague Poonam joins in with that analysis. Poonam?
Well, Infosys has certainly outperformed TCS as well as Wipro in terms of the Q3 earnings, and I would say that it is a beat on most counts. In fact, if you look at the IT sector earnings, both TCS and Infosys have stated that they expect double-digit growth in FY22, with TCS in fact stating that they are aiming for double-digit growth even beyond FY22. TCS, Wipro, Infosys, they have all stated that they are seeing very strong deal momentum across verticals and across geographies, and also TCS as well as Wipro reported a very strong EBIT margin expansion. All 3 IT players have reported a beat in terms of the earnings revenue growth, and also we're seeing a very strong positive commentary coming in from all of them. And in fact, Infosys has gone ahead and revised FY21 revenue as well as EBIT margin guidance upwards. Speaking about Infosys particularly, well, the revenue growth has been the highest in the 8 quarters, with revenue growth of 5.3% quarter on quarter in constant currency terms. Large deal wins at 7.13 billion is at an all-time high. FY21 revenue guidance has been revised upwards to 4.5 to 5% in constant currency terms, and revenue and EBIT margin guidance has been revised to 24 to 24.5%. Digital revenues also have crossed 50% in terms of the total revenue, and management sees a very strong TCV of large deal wins. In fact, if you look at the Wipro earnings also, the EBIT margin expanded 243 bips on a sequential basis, came in at a 22-quarter high. They have closed a very large deal in continental Europe, and 5 out of 7 sectors have posted 4% sequential growth. You are very strong. They're seeing very strong momentum across the board, across geographies and across verticals, and overall they see Q4 revenues to grow at 1.5 to 3.5% quarter on quarter.
All right, now I just want to refer to the SAIL OFS which has opened. Now SAIL OFS has come at a discount. If you have a positioning in SAIL, suddenly the government paper is coming at a discount. Now, Devang, is this a good way to handle OFS? Government comes, they are trying to encash their ownership in SAIL at the peak of the cycle, which is great news if you're a seller. But for those who are active in the F&O market and have bought SAIL, and SAIL is an F&O ban, suddenly the stock comes at a discount.
Nikunj, this is the entire problem with the PSU space, and this is where a lot of people like us never recommend a PSU stock, and that is what we have seen. So we are ready to probably miss even 100% or a 200% rally on such themes, which supposedly are some of these companies are very good companies, not speaking particularly about, of course, SAIL, but a lot of such companies which are Navratnas in India or Mini Ratnas are great companies in their own right, with some of them leading monopolistic businesses. But this has been the only problem over there. Though the dividend yield has been fantastic, a lot of these companies declare special dividends in the month of February and March, and that season is again approaching where government wants sort of dividends from them. So this will be good yield plays, but whether India is a yield market, India is a growth market, answer is India clearly wants, Indian investors clearly want sort of growth. So once you try for a dividend yield stock, and again, because of this type of a cycle, government will always come with OFS as it also needs funds. So then there is always going to be a dichotomy, whether you earn in terms of dividend yield or in terms of growth. So my answer is yes, avoid PSU bank stocks. And as you rightly said, a lot of traders who have positions here are probably going to be facing a lot of headwinds once this OFS comes. And I think this is just the start. A lot of OFS will be in the pipeline, as we have seen a good run up in PSU and particularly government run Mini Ratnas and Navratnas. So yes, this is the risk you face. So probably if you are a trader or even an investor, you need to take a good notice that these things will come up quite often.